Today was a messy day for gold and NASDAQ. We can see gold right here really just consolidating, and we can see NASDAQ for the most part consolidating with a little breakout later in the day. This is actually normal to see happen when we have important economic events coming up. And in this video, I'm going to cover why this happens before we get big news releases, and also my 3-step process for preparing to trade for tomorrow's inflation data. And I'm mainly going to cover gold, US dollar, and equities like NASDAQ, US 30, and SP 500. My name is Josh Pavao, and I've been trading fundamentals and economic data for over 5 years now, and I've been doing it with Day Trading University live every day for 3 years. Let's start off by defining what CPI is and why it's important. CPI stands for Consumer Price Index, and this is basically just how we measure inflation. It shows us how much everyday prices for things like food, rent, and gas are going up or down. This data is important because it's mainly what the Federal Reserve has been paying attention to in order to make their decisions on whether or not they're going to cut interest rates, hold interest rates, or hike interest rates. As of lately, it's gained even more importance because of Trump's tariffs. We want to see if this is actually going to be impacting inflation or not. This is what the Federal Reserve is paying attention to as well. There are a lot of things that can move the markets, but I think it's a pretty safe bet to say things like interest rates, inflation, and obviously economic data, these are some of the biggest movers in the markets. And if you can learn how to identify or analyze the data correctly, it makes it much more easier to stay profitable as a trader. So when we're taking a look at the markets and we're looking at this consolidation, remember in the beginning I said it's pretty common to see something like this happen when we have high impact events or data or something coming up. We're just looking at buyers and sellers in the markets, right? If I were someone who had these hundreds of millions of dollars and I'm able to move the markets, doesn't it make sense that I'm probably not going to be doing some big buy orders or sell orders if I don't know what's going to happen with this inflation data? This is usually why before big events, we get consolidation or choppy markets. It's normal to see choppy markets and fake outs before we get high impact data. In a nutshell, this is my 3-step process. Number 1, I want to cover expectations, which is basically just what are the markets expecting. Number 2 is going to be surprise, where we're going to cover what happens if it comes out higher than expected, what happens if it comes out lower than expected, and number 3 is bigger picture, which is basically just asking, is this going to impact interest rates? Now, let's start off with number 1 and get right into the expectations. So for expectations, we're going to bring over my economic calendar and we'll look at this right here. We can see that there are 4 pieces of inflation coming out, right? You have core CPI, month over month, year over year, and then you have CPI, also called headline CPI, and then you have month over month, year over year. Now, the first thing that you want to know, or at least that I want to expect, is I don't want to see mixed data. I don't want to see one of these pieces of data come out above or one of them come out lower. I want everything lower or everything above. Now we can see the expectations here. You have the 0.3, 3.0, 0.2, 2.8. Don't worry about remembering these numbers. I just want to know if it comes out higher or lower. You have the minimum and the max here, which you're only going to get if you have a special economic calendar. You're not going to see this on those free resources like Forex Factory. So this is why I use this calendar with Day Trading University, because it gives us more data. So we can see the expectations. Let's move that over to the side and let's cover what I'll be looking for as a surprise. This is a cheat sheet that I use with Day Trading University because I'm a very visual person, and hopefully this helps you guys too because this helps me. Now before I get into this, just understand that this is just expectations on what I'm looking for. None of this is 100% in the markets. Do your own research. I have no idea what I'm talking about. Now, if inflation data comes out lower than expected, which we can see right here, below expected, that means inflation's dropping. The reason I have these 2 arrows on gold is because if it comes out lower, I expect the US dollar to drop because the markets are still going to continue to expect interest rate cuts. That's bearish for the dollar, but gold might spike up for that because the dollar and gold have an inverse correlation, meaning usually if the dollar drops, it drives gold higher. But I would expect this to be short term. Now, if I get the opportunity to take sells on gold after it spikes up, that's what I would be looking for. Reason being is because gold has a strong correlation to inflation expectations, right? If you ever heard the term gold is a hedge against inflation, if we take a look at inflation expectation on this chart, look at gold. You see the candlesticks, right? It was pushing up, inflation expectations pushing up. Here it was pushing up, kind of consolidating here. Inflation expectations are moving sideways, right? So this isn't 100%, but this is why I'm saying if I see inflation drop, that's why I'm going to be looking for the potential spike up on gold. That's really just going to be driven by dollar weakness, but I'm actually going to be looking for gold to drop because if inflation drops, inflation expectations are dropping, and then I'm going to be looking for gold to drop as well. But I actually think the easier trade is going to be looking at equities because as long as the markets are continuing to expect interest rate cuts, I have no reason to be looking for sells on NASDAQ or US 30 or any of those. The only thing is we have any of the geopolitical tensions or if we have something that happens with Trump, those are really just my only opportunities for taking sells on NAS. Anything other than that, I'm just waiting for the pullbacks to happen and taking it higher. So ideally, if it comes out lower than expected, my favorite is going to be looking for equities to push up. And then maybe later in the day, if I see gold dropping, I do still expect that to happen, I'm going to be looking for gold to drop. For me, that would be ideal because I don't like entering two trades at once, especially with this high volatility when we have data coming out. So if I can catch a trade on NASDAQ, and then later in the day, if gold starts to drop and it starts following inflation expectations, I can get my profit on NASDAQ, leave a runner, risk-free, whatever I want, and then I can enter a new trade and take more risk on gold after I've already taken my profit from something else like NASDAQ. But what I don't like doing is entering multiple trades at once with high volatility. So what if the inflation data comes out higher than expected? This would basically be telling us that we have sticky inflation. Now, this can be a little bit tricky, right? Because the markets could stop expecting a rate cut. This could cause a short-term reversal, but as long as the markets still expect cuts, I'm not changing my overall bias, right? I said that before. If inflation comes out higher than expected, we'll take a look at this. Maybe tomorrow we'll do a market update after the data, and we'll see if we change this 88% probability for a rate cut. Most likely, if inflation comes out higher than expected, we're gonna see this 88% drop. The markets will stop expecting the rate cut. Now, that drop, that short-term drop, right, would end up giving us short-term dollar strength, potentially a drop on NASDAQ, and a drop on gold, right? Because when the markets stop expecting interest rate cuts, they call this higher rates for longer. This would be short-term negative for gold. It's going to be short-term negative for equities like NASDAQ, US 30, and it's going to be short-term good for the US dollar. But remember, just like I said, gold still follows inflation expectations. So if inflation is coming out higher, there's a pretty good chance this is going to cause a lot of uncertainty. So I would expect gold, if it does drop, to just wait for it to flip back up. Something like equities can be a little more tricky because there's a couple things happening here. Equities are risk assets, meaning when there's market fear, it normally drops. Like if you go look at NASDAQ or US 30 when there's like war or something bad like recessionary fears, we end up seeing it drop. So if inflation comes out above expected, there is a chance the markets start overreacting to the point that they might think that it's tariffs that's causing this, and we might see a pretty exaggerated move to the downside. But like I said, as long as I'm still expecting rate cuts, I'm still just going to be looking to take NAS sells. I'm going to wait for the reversal and I'll take it back up. It doesn't mean it's going to happen in the same day, but I'm not changing my bias. When it comes to actually taking the entry, I can do a technical analysis breakdown, but when we take a look at the charts, price might be in a completely different place. I can sit here and be like, yeah, just look for support to hold and take the buys, or look for a breakout here. We have no idea what price is going to be by the time you watch this video, or if inflation data is already passed. So if you'd rather just see this data come out live and take the trades with me and Day Trading University, you can join us for free. There's a free trial link in the description below, and I'll see you guys there.